Hello, everyone. Thank you for tuning in to our latest California housing market update. My name is Oscar Wei. I'm a senior economist and a director of research at the California Association of Realtors. Um, it's a pleasure to be here to share some information with you about the economy as well as the housing market. Um, last time we did a housing market update, it was probably about a month ago, and I apologize for not being able to provide those a little bit more sooner. But we do have a lot more information this time, and we would love to share some information with you with the economy as well as the housing market. So let's get started now. Um, of course, the economic update as well as the housing market update hinges on the current pandemic situation. So let's give a couple minutes of the coronavirus update first before we get into the economic and housing market update. Now, in the last couple weeks or so, you probably have already heard from the news that we do have some spike in new cases in California. Since reopening in about 3-4 weeks ago, the number of cases has spiked up in the last couple of weeks. New cases increased, probably has to do with increase in number of testings also. If you take a look at the last couple of weeks, the number of cases went up to over now, total number of cases went up over 220,000 now. Number of new cases on a daily basis fluctuate around 5 or 6,000. That's significantly higher than what we saw in what we saw at the beginning of May or April when things were started slowing down, but it started coming back up again. So why? As I mentioned, new testings probably is one of the reasons, but it's not the only reasons. Since the reopening, we do have some probably people relaxed a little bit. We also have more interactions since the reopening, as people go to the beaches, go to bars, and as such, that actually led to an increase in the positivity rate as well as number of people going into hospital, being hospitalized. If you look at new cases, as I mentioned, we have the latest number shows over 6,000 cases at the end of June, and if you look at the number of hospitalized patients, though, that number also surged significantly. So that number may or may not have a lot to may not hinged on number of active testings. So when you see the positivity rate really went up, that signifies or suggests to us that we have been relaxing a little bit, and the new active testings, the new active testing, like I said, will increase number of cases, but the positivity rate went up from 4.4% a few weeks ago or 3 weeks ago to 5.6%, which is the latest number that we have. That's really suggests that we need to be more concerned about the coronavirus pandemic situation. Now, we definitely want to make sure that we keep it under control, and it will not continue to threaten or derail the economy. But and in doing so, we need to make sure that we continue to practice our social distancing measure, as well as to wear our face mask and things like that to keep it under control. Because otherwise, the economy will have to be locked down again, and that will slow down the economic recovery as well as the public health recovery. And of course, the coronavirus pandemic situations, as the resurgence, if it continued to resurge, it's going to lead to more damage for the economic output as well as the labor market. Let's take a look at what it has already done to the economy and the labor market first. Now, if you look at some of the statistics that we have been providing, and probably from what you can hear from the news, the economic output really has gone down starting at the end of first quarter. As such, it really pulled the first quarter number down to a negative. If you look at the first quarter number, it went down. GDP went down by 5%. Economic output went down by 5%. It's the largest that we have seen since the last recessions in 2008, 2009. Keep in mind, though, this 5% decline was only due to 2 to 3 weeks of shutdown. Imagine what's going to happen in the second quarter. Second quarter, we have April shutdown and part of May shutdown, and potentially we could have more shutdown if we don't control the coronavirus pandemic. But let's take a look at the retail sales numbers. The reason why we want to take a look at retail sales number is because it really is a reflection of consumer spending, which is a big part of the GDP economic output. So retail sales dropped in March by 8.2%, and then follow up with another decline on a month-to-month basis by close to 15%. Now, with federal assistance program kicking in May, when people started getting unemployment benefits, we saw a surge in retail sales in May. But this surge in May, which is very impressive, 18%. This surge in May, though, when compared to last year, retail sales still down by about 6% compared to last year. So we can expect, the second quarter retail sales as well as consumer spending as well as GDP to actually decline from last year. How much, it's really hard to calculate, but most economists believe that it is going to be down by somewhere between 30 to 40% for the second quarter GDP. So we were down 5%, and then we were expected to be down maybe somewhere between 30 to 40% in the second quarter. And you can get a sense by looking at some of the other indicators as well. The labor market, as I mentioned, is one of the areas that got hit really hard. If you look at unemployment rate, it is currently at around 11.1%. Now, it's a little surprise, the number that got released earlier today was a little surprise to myself, to me, and to many economists, as most economists believe that the number is going to be worse. But unemployment rate right now is at 11.1%. Now, that's an improvement from last month. Last month in May, it was 13% or so. I can't remember the exact number. And then the month before that was close to 15%. So a decline of an improvement from the previous month and the month before was a little unexpected. Now, it is partly because of, not partly, it is primarily because of increase in job growth. Now, the job growth, number of jobs increased by close to 2.7 million in April, and it increased again, the latest number it increased by 2.7 million in May, and then it increased again by close to 5 million in June. And that really helps, to lower the unemployment rate down. Now, with a 7.5 million increase in jobs, it is still, however, behind the number that we saw in the early part of the year. And the reason is we actually had a very, very significant drop in April. 20 million job loss in April because of the shutdown. A lot of people have to lay people. A lot of companies have to lay people off, as well as doing furloughs. So even with a 7.5 million job growth in the last couple of months, we're still behind by 15 million. It's going to take some time, for the economy to come back. There's no doubt about it. And total and non-farm employment continue to stay at a level that is significantly below what we saw early part of the year. And because of that reason, unemployment rate, will probably continue to stay at a high level for quite some time. Now, we can look at a little bit more recent number on a weekly basis to get a sense of where we will be going, from this point on. Now, unemployment benefits, the Bureau of Labor Statistics release unemployment benefits statistics on a weekly basis. So let's take a look at those numbers and see, what the current trend is. At the beginning of the year, before COVID-19, we had, about 200 to 300,000 jobless claims, or people who file for unemployment claim on a weekly basis. So those initial claims come in usually around 200,000, 250,000. And of course, with the shutdown, spiked up significantly, first to 3.3 million and then to 7 million. Now, from that point on, we started gradually declining. And recently, the latest weekly number from the last week of June, we have a decline. The initial claim, the people who file an unemployment claim for the first time, dropped down to 1.4 million, still just slightly below 1.5 million. But no, so yes, it has been declining for 13 consecutive weeks, but the decline has been very, very slow. And it's very likely that for the next few weeks or so, we probably will continue to stay above 1 million. Especially since, as I mentioned, we're seeing a resurgence in coronavirus. That means economy will probably slow down a little bit um, until we get those pandemic situation under control. So the economy will probably slow a little bit. And especially since the number of people who continue to file claims amount to close to 20 million continuously for the last few weeks or so, and that number is actually going down very, very slow. So what about California? If you look at California, the number of people who file unemployment claim is pretty consistent with what we saw in the state level. At the beginning of the year, again, before coronavirus pandemic, on a weekly basis, we get maybe about 45,000 unemployment claim. But recently, the number has soared at one point over a million, and then recently stabilized at around 280,000. That number is still very, very high, and in fact, it's about 6 times, 7 times above the normal. So that's pretty significant. The current stabilization of the labor market situation, and probably some improvement in the early part of June and maybe late May in the stock market kind of help consumer confidence, kind of help boost up consumer confidence a little bit. Consumers in June actually saw consumer confidence actually bounce back to close to 100 from 85, 86 in April and May. That's a real bounce back, and that's because people are a little more optimistic about the economy. Part of the reason also is because of the financial assistance from the federal programs, from the PPP and the PUA. Kind of helps people feel a little bit more confidence. But again, I am not sure if that increase in consumer confidence level will increase. I think it will probably level off in the next month or so, especially since the virus infections started rising again. What about the market? You might have heard from some of our previous presentation that the market actually will be a bright spot. Now, judging by the current monthly statistics, that's hard to believe, because if you look at our latest monthly statistics from May, we actually saw sales of existing single-family home in California drop quite significantly. But keep in mind, May close sales numbers reflect what happened. Is sort of like an indicator from the rearview mirror, because a lot of people who show interest in buying a home or open escrow in April will close in May. So these close sales reflect, those people who showed interest of buying home in April. Now, we should really look at pending sales in a minute to see, where things are right now, a little bit more current picture of what's going on with the market. But first, let's take a look at the monthly statistics. If you look at the May number, as I said, it dropped by 40%, 41%. That's the biggest drop that we have seen. Again, the biggest that we've seen since late 2007, when we had our last recession. As far as price is concerned, though, it also dipped, but it didn't really dip as much as what we were afraid of. It dropped 3.7%. That's because we still have tight supply, and the number of days on market for a property to stay on the market is about 17 days, and the sales price to list price ratio is pretty much flat. So let's hone in a little bit on some of the indicators and see if we can understand a little bit more. Look at home sales. The state home sales, again, as I mentioned, dropped 41%, and it has been fluctuating on for the last 2-3 months. It dropped to first 6% and then another 30% before dropping to 41%. Now, I do believe that we are very close to bouncing back. In fact, if you look at the pending sales number, pending sales number in May sales that were closed in June and maybe in July. Take a look at what happened with the pending sales figures. On a month-to-month basis, the pending sales figures actually increased by 67%. That's a significant increase from the previous month. Now, with that 67%, we're probably going to see an improvement in closed sales in the upcoming months. When we compared the pending sales number on a year-over-year basis to last year, it only dropped, pending sales in May only dropped about 5.5%. Now, you probably can see some, reflections of the pending sales to closed sales here. In April, when we had a 43% drop in pending sales, we ended up with a closed sales dropping by 41%. So with a 5.5% drop in pending sales in May, in June, we'll probably end up with a single-digit decline in May and in June, on closed sales in June. So that's not too bad. Of course, taking into consideration that we actually had, 30% and 41% drop in closed sales, not too bad in June. Now, but it's going to be a decline. The degree of decline will vary between individual price point. For pending sales, it's going to drop by continue to drop by about 2.5% for the more affordable segment, which is below $1 million. For the $1 million to $3 million, it actually will increase very small, 5.6%, and for the $3 million and up, it will increase dramatically by 25%. Now, the $3 million plus is actually a very, very small segment of the market. So, a search in a small price segment is probably not going to do a whole lot to the entire market. But nevertheless, it suggests that the luxury market or the high-end market is actually doing a little bit better. What about price? Price experienced its first decline at a state level. The state number dropped 3.7% for the median price, which is actually the first drop since February 2012. We had a really good run. For 8 years in a row, we have been actually doing fine. We have been showing year-over-year increase in price. And so this is the very first decline in price. Now, the degree of decline also varies by price point. Instead of showing you the price ranges, we have it by percentile. If you look at the lowest percentile, the 0 to 20th, which is probably, you can think of it as, the price range between 0 to 300 to 350 or so. That segment, because of tight supply, continued to show a slight increase of 0.4%. But all the other price segments dropped, varies from 0.3% to 3.3%, with the luxury or the high-end market actually dropped furthermore. This trend probably will reverse in the upcoming months, in June or July. When we take that into consideration, take into account, all the different price growth in different price segments, we may actually end up with a slight increase in June. With our prediction, though, as you will see later on, our forecast still suggests a slight decline. And I'll go over that in a minute or shortly. The housing market going to do a little bit better in June and July probably has something to do with the fact that we do have a very, very low interest rates. If you look at interest rates, many of you probably are aware of, interest rates, average 30-year fixed rate right now is about 3%, 3.1%, and 3.5% or so. And in the next few weeks, there's a chance that it may actually go below 3%. And how does that, help consumers or potential buyers? Take a look at, this chart here, and you'll see, we use the median price, the statewide median price, apply the prevailing interest rates to the median price of a typical home, and get a monthly mortgage payment figure. And you can see the monthly payment mortgage figure for May 2020, with low interest rates and price actually declining by 3.7%, will yield a monthly mortgage payment of $2,040. And compared to last year with an interest rate about 80 basis point higher than current interest rates, buyers who purchase a home today versus than a year ago will save about $300. That's really is a significant difference. That amounts to about 13.2% difference, comparing the two mortgage payments. Now, for many potential buyers, this is a really good chance to buy, to lock in a low rate, and also to take advantage of the to take advantage of the softening in price. Um, rates probably will stay low for a little bit of time, but then and price probably will continue to stay soft and not grow too much. So this is actually a good time for many home buyers to buy. Now the problem, of course, is supply. We're not seeing a lot of supply in the market. In fact, if you take a look at number of active listings, it actually have been dropping more than 25% for the last few months. In fact, the latest monthly statistics actually dropped more than 30%. Um, Sellers, of course, they're still concerned about the pandemic situations. Many of them are not listing their property on the market. Um, Many realtors are able to show their homes virtually, but the other problem for many sellers is many of the sellers are also buyers. They may not be able to find a house that they can buy, and so that's why they're not selling their property or list their properties for now. So let's take a look at some of the weekly statistics. I mentioned earlier that yes, the monthly statistics are probably a little bit dated. Let's take a look at some of the weekly and see if what I mentioned earlier about pending sales being converted to closed sales will materialize. In fact, if you look at the state number, look at the number. A few weeks ago, we have closed sales bottom out. Maybe mid-May or so, we have closed sales bottom out, and then on the weekly basis, we started rising. Um, the week before last, we actually hit a high of 691 daily average closed sales. That's much better than, that's about 10% higher than what we saw in early March. But then in the latest week, we start seeing some leveling off. So closed sales in June probably will turn out to be pretty decent. But July's numbers, we may see a little bit of softening. The softening could be because of multiple reasons. But let's take a look at pending sales and see if pending sales actually mirror a similar trend. If you look at pending sales also dipped. Now the pending sales actually dipped a little bit, bottomed out a little earlier, maybe in April, and that's why closed sales bottomed out in May. But it started trending up. It continued to trend up quite significant, quite impressively until the latest week. Latest week also dipped a little bit, for pending sales. That suggests that there might be some reasons behind the slowdown. It could be because of lack of supply. I mentioned about lack of supply earlier, but also the resurgence of coronavirus, which could actually slow down market activity, and concerns about what's going to happen with the economy and the market. So people might be holding off a little bit because of the pandemic situation. But also, it could also be the shutdown actually might have built up some pent up demand in April or May, and as such in June, people rush to the market and try to take advantage of the low mortgage rates, and as such, we're seeing a lot of sales, and then it starts slowing down. And yet another reason could be, yeah, typically the housing market buying season is between April and June or so, and it could be tailing off or transitioning into the low buying season. So we'll have to see if this trend continue and see if the slowdown will continue. Now there are other indicators that suggest that we probably will see a little bit continue to see some momentum. Showing activities numbers collected from showingtime.com suggest that as far as weekly average showing is concerned, we still see pretty robust gain compared to last year. Now this orange line right here is the weekly average compared to the beginning of the year. So right around here, at the end of March, we saw a dip of average showing significantly below what we saw last year. We significantly below what we saw early part of the year. It dropped about 60-70%, but then it started trending up. In fact, at the end of at the beginning of July or end of June, that number started trending up, and that number compared to last year, it's actually 55% higher than last year. Pretty encouraging. Now, another encouraging sign is based on a mortgage application. This is a national number. Now, based on a national number, on a year-over-year basis, the number of mortgage purchase applications continue to exceed last year for the last few weeks. I mean, it dipped below last year's for a few weeks, and then it started trending back up, by mid of May. And recently, for the last couple of weeks, it has been increasing from last year by double digit. The concern, again, is mainly on the supply side. If you look at the active listings, the state active listings remain at the lowest in the last 4 weeks. At a state level, take a look at this number again. It kind of peaked 4 weeks ago, and then it started trending down. It's still below early part of the year by about 20%. So this is a concerning sign. It could constrain sales, but it could probably also help prices to stay afloat a little bit. So let's take a look at what we can expect in the next few weeks or next month or so, or next few months or so. First, let's take a look at the economy. The economy will continue to trend down in the second quarter, as I mentioned. Many economists believe that we are going to go down by 30 to 40%. Let's take a look at all these different economists. UCLA, for example, projected that second quarter will go down by 42% before bouncing back in the third quarter and the fourth quarter. For the year as a whole, we probably will end up with a number that is close to 5 to 10%. What about a housing market? Housing market is going to have a faster bounce back. In June, as I mentioned, I think sales will probably go up by, will probably bounce back. We'll still be down from last year by maybe about 6 or 7% based on the pending sales trend, and will continue to stay below last year's for the rest of the year. But if that is the trend, and if we stay at that level for the year as a whole, we probably will be below last year. For the year as a whole, we probably will be below last year by about 12, 13%. As for price, we are seeing price dipped, and we saw price dipped by close to 4% in May. With low interest rates, I think we will probably continue to see prices drop below 2 to 3%, maybe even get up above last year's level for 1 or 2 months for the rest of the year. But for the projections that we have here, we're being a little bit more. We have been a little bit more conservative, and we'll keep the conservativeness for a while until we get a little bit more certainty. We predict the rest of the year to drop 3 to 5% for the rest of the year. But for the year as a whole, we probably will end up with only a drop of 1 to 2%. Next year, we'll probably bounce back. So to wrap it up, here are some of the key highlights. So I think the economy is going to bounce back, but the recovery is going to take some time. It's not going to be right away. We probably will see the economy bounce back, the unemployment rate get up to maybe 9% by the end of the year, and 2021 will still be below the unemployment rate that we saw earlier this year. The question is, whether we're going to see a resurgence. That is concerning, and if we do, then the slowdown will continue. In the housing market, sales are expected to bounce back a little bit in June and July, and for the rest of the year, probably down compared to last year. But it's not going to be as bad as we previously thought. Tight supply will be an issue, though. Tight supply will continue to be an issue. That's because sellers may not necessarily be encouraged right away to list their properties in the markets because of the current pandemic situation. So the market will continue to be tight as far as supply is concerned. That's going to help prices, but still, we are still going to see some softening in price, and we expect a slowdown in price for the rest of the year, or softening in price for the rest of the year. Now, housing market will continue to be a bright spot. It's going to do better compared to some of the other industries, some of the other sectors, but the recovery will continue and for the rest of the year and in 2021. With that said, I hope I was able to give you some good information, and we'll continue to monitor the market and the economy, and we'll report back when we get more statistics in a few weeks. Thank you very much for tuning in again, and until next time, have a good rest of the week, and good luck. Bye-bye.